Now we get to the second major method of finding a stock's intrinsic value, and this is the corporate valuation model. So this model uses the firm's weighted average cost of capital as the discount rate to discount the firm's future free cash flows starting at t equals 1 to arrive at the firm's corporate value. Free cash flows represent cash generated from current operations less the cash that must be spent on investments and working capital to support future growth. Free cash flows are funds available to all capital investors, and thus they are discounted at the firm's weighted average cost of capital. Once the corporate value is determined, the current market value of debt and preferred stock is subtracted to arrive at the firm's equity value. Then the firm's equity value is divided by the number of shares outstanding to calculate the firm's intrinsic value, that P sub 0. The corporate valuation model can be used to value divisions and firms that don't pay dividends. The discounted dividend model that we were talking about before could not be used in those situations. So you would just use this equation to find the free cash flows for the firm. So it's earnings before interest and taxes times 1 minus the tax rate plus depreciation and amortization, and then minus capital expenditures plus the change in net operating working capital. Now we won't get into so many details as to how to calculate free cash flow in this chapter, but we'll use the free cash flow that's given to us in a problem, and it will be similar to what we did with the supernormal growth model type question. So again, the steps: we're going to find the market value of the firm by discounting all the future free cash flows of the firm, and then we'll subtract the firm's debt and preferred stock, and then we'll divide the equity value that's remaining by the number of common shares outstanding to get the stock's intrinsic value. And then we could use that stock price to compare what's the stock price in the market to, and we can make a decision if it's undervalued or overvalued. So this model, like I mentioned before, it's great for firms that don't pay dividends, or just even as a backup measure to calculate intrinsic value, or if dividends are kind of hard to forecast for the company. And then we'll also assume, just like we did before, that there's a certain point where the free cash flows will grow at a constant rate. And that horizon value is the point where we were switching from like the supernormal growth rate to the constant growth rate. The horizon value represents the value of all of the free cash flows after the point where it becomes a constant growth rate future cash flow stream. And so here's an example. It looks like what we were doing before. The only difference is the -5, 10, and 20 are all free cash flows for the firm. So they already gave those to you. You didn't have to use that longer equation that we saw a couple of slides ago. And so they say that, and again, remember, since these are free cash flows, we're not using R, the required rate of return for a stock. This is for the whole firm, so we're using the weighted average cost of capital, and that WACC represents the average cost on its debt and equity, and its common equity, its debt, and its preferred stock. So, but it's the same concept for what we're doing. It's the same process. The long run growth rate is 6%, and the discount rate that we'll use, the WACC, is 10%. And so it's the same thing. We'll discount each cash flow back. This time 1 cash flow is a -5 for a free cash flow, and then 10 and 20. And then after the free cash flows start to grow at a constant growth rate of 6%, we need to get free cash flow at time 4 to get the present value or the horizon value at time 3. So we get 20 times 1.06 is 21.20 divided by the WACC minus the constant growth rate. And so we get the horizon value at time 3 of $530. And then we get all the present values and sum them up like we did before. Now, if we wanted to solve this in the calculator, we would go again to our cash flow register, second, clear work, make sure nothing else is in there. Go to cash flow 1 and hit 5 and negative, keeping in mind that's a negative cash flow. And then go down to cash flow 2, that's 10, and I'll enter it. And go down to cash flow 3, 20, and I'll enter it. And I'll go down, oh, whoops, I'm sorry. So see, I forgot to add the 20 and the 530. So it's good that I made this mistake so you can see this and not make this mistake on your own. So cash flow 3, remember we had to add 20 and 530. So we'll have 550. So 550 is what cash flow 3 should be. So I just overwrote that number. And then I go to NPV and I enter in the weighted average cost of capital. I hit the down arrow and hit compute. And you see that we get the value of the firm is 416.942. And that could be in millions of dollars. So we take that 416.94 and we're going to subtract out debt and preferred stock. And so they told us that they have 40 million in debt and 40 million in debt and preferred stock. So we'll just subtract 40. So we get the market value of equity by backing out debt and preferred stock. And then if we have the number of common shares outstanding, which is 10 million, and since these are both in million, we can write these shorter numbers and take that market value of equity of 376.94 and divide it by 10. And so we get an estimate for the stock price. The intrinsic value is $37.69. And again, as always, we would compare this number to what the stock is selling for in the market currently.